Welcome to this week's Market Minute. My name's Andrew Wilkinson, and I am joined in the IBKR studio by Chief Strategist Steve Sosnick. Welcome back to the program, Steve. How are you?
I'm doing well, Andrew. Thank you. How are you?
Doing okay, thank you. Markets are up to all sorts. What's going on? Are we ever going down again?
Nope. Apparently not. Nope. Never. Um, Obviously, that's a facetious answer, but right now the momentum is so strong. The belief in markets is so strong that right now traders, particularly in the US, but even globally, because a lot of global markets are hitting all-time highs as well, right, are just shrugging off any amount of bad news. I facetiously have been I put out a facetious rubric on Traders Insight with basically wake up, buy futures, maybe get around to brushing your teeth. If there's an 8:30 number, if there's a dip after that, well, then use that as a buying opportunity. If there's a 10 o'clock number, use that as a buying opportunity. As we're taping this today, Monday morning, the 8:30 ADP number, which was pretty lousy, proved to be a buying opportunity. Futures sold off and then opened higher. As we're taping this now, the ISM numbers just came out. They look truly astonishingly bad, at least at my first glance. I'm sure the market will treat that as a buying opportunity later this afternoon. Then wait for the Europeans to go home at 11:30. So get them out of the way, push it higher, and then buy into the close because there always seems to be money flowing in at the close. And so let's beat the market on close and balances. Obviously, life is not that simple. Somebody made a joke on one of the to me that can they program that into the IBKR API? I guess in theory you could, but reality that can't necessarily last. Breaking it down, the 350 rally is strictly because money is flowing into ETFs and mutual funds, and that's the traders at those funds' way of guaranteeing a decent close and a decent trading performance for themselves. If you've been buying all day and the market closes at its high, that's probably a pretty good thing for your results. But realistically, there's this faith that the market is just going to bounce back from everything. I don't want to use I'm trying to avoid the term that the market's assigned to how it views the tariff trade. I think that's political, and it's not our role to be political, but the market is certainly looking through any tariff noise at this point. And to be fair, it's understandable why, because every big pronouncement has either been postponed to some degree or rolled back to some degree or backed off. And, the only one that's really gotten the teeth so far are the steel tariffs that went into effect today. And so I think the market has decided that tariffs are a lot of noise. The political scene in Washington is a lot of noise. And even though earnings expectations for the S&P 500 are lower than they were the last time we were flirting with the 6,000 level on the S&P 500, the momentum is in your favor. Momentum, I've written this before, momentum at its purest form is saying we're only caring about price action. Therefore, I don't really care about fundamentals. We know that only works for so long so far, but that is the mentality the market has right now.
But surely, Steve, there must be some concerns in the background.
I view the biggest concern to be the bond market. And when I hear people like Jamie Dimon and Ray Dalio expressing that same concern, I have to think that maybe it is a pretty valid concern. When we break this down, again, not getting too political, we had seen, at least in the aftermath of the tariffs, a flight basically from the US. And I've written about this a couple times where we saw S&P 500 trade down overnight and then get it all back during the day. And essentially that had been the pattern. Now it's equalizing a little bit. I think part of the reason it's equalized a little bit is that US traders have gotten a bit more aggressive at the part one of the thing I just discussed and buying futures before they brush their teeth kind of thing, before their first coffee. So I think that because that registers as an overnight session. But still, we're looking at a situation now where the budget bill passed the House. At its some level, it's going to raise the deficit. I know that that a lot of the proponents have been dismissing the Congressional Budget Office and saying that they get it wrong. Actually, over time, don't necessarily get it that wrong. And so it involves a bit of supply side thinking that I think can be a bit dubious sometimes in terms of the benefits of the tax cuts. But regardless, if you're trying to reduce a deficit, there's two ways to do it. One is by cutting spending. One is by raising revenue. The bill works on the former, but not the latter. Now, I'm not sitting here advocating for tax hikes, but if you're going to continue with on a larger spending path, even though you are making cuts, you're not going to necessarily, you're maybe slowing down the rate of growth, but not necessarily of the deficit and the debt, but not necessarily shrinking it. At some point, you do have to wonder: are we over one bad auction away from something really terrible? We're not there yet. And to me, the thing that I watch most closely is the 210 spread, because that is telling us, that can tell you very bad things if that starts to expand. Because if you start to see the 2-year yield start to shrink dramatically, that's the market telling you they're afraid of a recession, because they figure the Fed has got the reason to cut rates. And what we've heard from Fed governors are they're much more afraid about restoking inflation than they are about a weak labor economy. We'll hear more about that on Friday. We heard from ADP today, which was not encouraging, but if you're talking about a 4.2 versus a 4.3 versus a 4.4% unemployment, that's still a pretty healthy labor economy. But with all the tariff uncertainty, they don't know what to do about inflation. So the Fed is not necessarily cutting, but that would bring the short end down. The long end up is fears about either future inflation or the government's ability to pay back its debts. I don't think the U.S. government really can or would default. The question becomes, though, are you going to get paid back in deflated currency or not? Inflated currency, deflated purchasing power. And because remember, and the bond guys don't get as seduced by all the same stories and rhetoric that stock traders can. Those of us on the stock side love a good story, and there's tons of them out there. Bond guys really only worry, they're pretty straightforward. They only worry about whether they're going to get paid back. And if you're a government bond trader, you're pretty much going to get paid back. It's just a question of how and when. And so this is why I consider the spread between 2s and 10s to be very crucial. We had a flirtation with 4.5 at the 10 years. We had a flirtation with 5 on the 30 years. That test proved the market bounced below those, the yields bounced below those levels, prices rose. Those two levels to me really are the ones to watch, because bond traders can get very squirrely all at once. They momentum trade too, by the way.
I guess the third thing to add there, Stephen, you alluded to it, but you didn't say it outright. It's an absolute rise in US yields, and again, relative to international yields. So I was envisaging perhaps like global bond yields go up, but I think it would probably manifest itself more in a widening in the spread between US and Germany, US and UK, US and Japan even.
For example, I saw a very good chart. I think it was from the former JP Morgan strategist, Marko Kolanovic, who he's got his own biases. He basically he had this chart of the US dollar index, and I believe it was the US dollar index and the US 10-year yield. And they moved more or less together.
Right.
And then in the last few months, we've seen a big dispersion. And his conclusion was, it says 10-year yields are going to be 4%. Now, if you believe strictly in correlation, yeah, I guess that's true. And again, being respectful of the term, it's different this time. I have to always be cautious when I use that. But if we are seeing money flow out of the US, that is what you would expect. You would expect to see the dollar weaken. At the same time, you would see the bond market stagnate, the bond yield stagnate. And can you get down to 4% again? Yes. I kind of shudder to think about the economic conditions that would be required for that to happen. And I certainly do not want to root for that. But I do think it's telling us that there's a fundamental shift. And I don't know if it's going to last or persist, but I think there certainly has been a secular move out of U.S. assets, certainly out of the U.S. bond market. And that is worrisome, considering we've said this before, our biggest export is our debt. Mm-hmm. We buy stuff in exchange for people buying our debt. And also you got to wonder, we could go down rabbit holes. So if we shrink the trade deficit, does that shrink the need for debt, et cetera, et cetera. But that's really what it comes down to. And that is the thing that kind of keeps me up at night. And the tell is that 2 to 10 year spread.
Steve, people are always looking for bubbles in good times and bad, but are we seeing anything at this point?
In general, no, but there's certainly what I'm going to call some bubblelicious behavior out there. I noticed one of the more active stocks in our platform was a stock SBET, and it was what is this? It doesn't even trade options. And it was, I think, $3 last week and $3 2 weeks ago and $80 last week at one point. Or I was thinking it got up to 125 or something like that. I don't want to go into the story. People can do their own research into it. But in a sense, somebody asked me to explain it to him. And I said, it's basically an unholy alliance, an unholy story involving Martin Shkreli, a short squeeze, and a company's desire to become an Ethereum treasury company. Wow. So you've got people, you've got financial alchemy. We do see this. Every week I see that there's a few stocks out there that just everybody seizes upon as momentum. Boom, the momentum gets going. Everybody jumps in. It gets an outrageous valuation. Again, the fundamentals do catch up over time, but you do get these crazy moves that creep up. And that doesn't happen if the environment is not, if there's not some froth out there.
The bubblelicious nature of financial alchemy.
And by the way, just to prove my point about the rubric on if bad news at 10 o'clock buy, the futures are more or less back. S&P is more or less back to where it was when we started the call, or just before we started the call. Despite the lousy ISM numbers, stocks have shrugged those off as well.
There you go. Thank you very much, Chief Strategist Steve Sosnick.
Thanks, Andrew. Take care.
And don't forget, if you enjoyed today's podcast, remember to subscribe wherever you download your podcast from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.